Hello, and welcome to the XFO Intelligence Podcast, where we bring you deep, augmented thinking on the most critical shifts in the global economy. Today's episode is all about the new Energy-Wealth Nexus, how UAE's strategic evolution is reshaping global capital flows. Before we dive in, remember to like, share, and subscribe to the channel, and send us your feedback at xfointelligence@gmail.com. We'd love to hear from you. Now, let's get started. The United Arab Emirates has reached a historic inflection point. In May 2026, the UAE formally withdrew from OPEC and the broader OPEC Plus alliance. More than an energy policy shift, this is a profound recalibration of how the UAE approaches economic autonomy and long-term wealth creation. We're seeing this transformation unfold across two critical dimensions: national energy strategy on the one hand, and private wealth architecture on the other. As the UAE asserts its independence over oil production decisions, family offices managing over AED 1 trillion are rethinking how capital flows. Portfolios, geographies, and generational priorities are all being reshaped. So what does this mean for the global economy? Flexibility is overtaking coordination. Transparency is replacing administered pricing, and adaptive resilience is becoming more valuable than static wealth preservation. Let's start with the UAE's strategic catalyst, its OPEC exit. On May 1, 2026, Abu Dhabi officially announced its departure from OPEC and OPEC Plus through its state news agency. The reasoning? Long-term vision and the evolution of the energy sector. But behind this diplomatic language lies a clear economic logic. First, capacity expansion. The national oil company, ADNOC, has poured more than $150 billion into infrastructure to reach 5 million barrels per day by 2027. But OPEC quotas were based on older baselines, constraining the UAE to around 3.2 million barrels per day, a mismatch with actual capacity. Then there's revenue optimization. With installed capacity much higher than the quota, there was significant foregone revenue. The timing was critical. In early 2026, regional conflicts had disrupted shipping through the Strait of Hormuz, keeping actual oil flows below capacity, so the UAE could exit OPEC without causing an immediate market shock. The immediate market reaction was mixed. Brent crude traded between $102 and $115 per barrel afterward. The market priced in geopolitical risks more than the new policy shifts. We see three emerging scenarios heading into 2027. A conservative increase in output, 200 to 400,000 barrels per day, which wouldn't lower prices much. A baseline scenario with a moderate increase, 600 to 800,000 barrels per day, potentially pushing prices down $8 to $12 per barrel. And an aggressive scenario with over 1.2 million barrels per day added, which would push prices down farther. The baseline scenario, gradual production aligned with global demand, is the most probable. Longer term, we're looking at a decentralized global oil market with 4 to 5 key benchmarks, and OPEC Plus evolving from a quota enforcer to a transparency hub. But energy is only half the story. At the same time, UAE family offices are shifting their strategy. Greater policy autonomy is creating new investment opportunities, and geopolitical friction, like the Hormuz disruption, is stress-testing portfolios in real time. Plus, a generational shift is in motion. Next-gen leaders are embracing tech and institutional governance. Right now, digital assets and AI are at the top of UAE family office priorities. 71% see digital assets as strategic. 65% are prioritizing AI investments. They're also leaning into infrastructure, from behind-the-meter power generation to U.S. LNG infrastructure, and they're rebalancing real estate holdings as Dubai property yields approach critical thresholds. Private markets are also growing in importance. Private equity is a core allocation, and private credit is gaining traction. But gaps remain. Over half of family offices still lack exposure to venture capital. Risk management is evolving too. Geopolitical risk is top of mind, but many traditional hedges are underused. Governance is a standout strength. UAE family offices lead the world in next-gen involvement and cross-border estate planning. So what's next? From May 2026 through early 2027, we anticipate 3 phases. First, consolidation and pipeline building, the infrastructure for new capital flows and AI-driven decision-making. Then, in late 2026, we'll see rotation and acceleration. As yields compress, capital will rapidly shift into private credit and infrastructure. By early 2027, we'll see a more mature growth architecture. Hybrid infrastructure platforms, AI-optimized allocation engines, and embedded risk pricing will become the norm. Each stakeholder has a role to play. UAE family offices need to streamline compliance and tie next-gen influence to learning velocity. Global asset managers must deliver Sharia-compliant overlays and pre-cleared investment pipelines. Policymakers can harmonize regulatory frameworks, and next-generation family members should focus on validation velocity, not just mandate size. Over the next year, keep an eye on key thresholds like Dubai real estate yields, Verbin futures open interest, and digital asset regulatory clarity. These will signal when the next phase of this evolution kicks in. In closing, 3 principles define the path forward: flexibility over coordination, transparency over administration, and resilience through redundancy. This is not about replicating old models. It's about mastering a new paradigm. Thank you for joining us today on the XFO Intelligence Podcast. If you found this episode valuable, make sure to like, share, and subscribe. We want to hear your thoughts. Send us feedback anytime at xfointelligence@gmail.com. Thanks for listening, and we'll see you next time.